Assalamualaikum warahmatullahi wabarakatuh. We are from Group 5, consists of Adiba Mufidah Hariswan, Haryandi, and Novigia Ferdini. Now we will try to discuss about Chapter 5, that is Analyzing Investing Activities, Intercorporate Investment, from Financial Statement Analysis 5th edition by K.R. Subramanyam. First, we need to know intercompany investment play an increasing role in business activities. Companies purchase intercompany investments for many reasons, such as diversification, expansion, and competitive opportunities and returns. This chapter considers the analysis and interpretation of these business activities as reflected in financial statement and analyzes financial statement disclosure for investment securities. And then, what is investment securities? Companies invest assets in investment securities, also called marketable securities, to meet companies' capital needs, can provide opportunities for outsiders to be able to invest in their company. This will make the company get enough capital, of course, with various applicable provisions. And then investment securities can be in the form of either debt or equity. And then we go to the debt. What is debt? Debt is securities represent creditor relationship with other entities. Examples are governments and municipal bonds, company bonds and notes, and convertible debt. Debt securities are classified as trading, held to maturity, or available for sale. Okay. First, held to maturity securities. What is that? Are debt securities that management has both the ability and intent to hold to maturity. In other words, they could be either short-term, in which case they are classified as current asset, or long-term, in which case they are classified as non-current asset. Companies report short-term or long-term held maturity securities to the balance sheet at the cost or amortized cost. And then trading securities. Trading securities are debt or non-influential equity. Securities purchased with the intent of actively managing them and selling them for profit in the future. Trading securities are current asset. Companies report them aggregate fair value at each balance sheet date. And then available for sale securities. Available for sale securities are debt or non-influential equity. Securities not classified as either trading or held to maturity securities. These securities are included among current or non-current assets, depend on their maturity and or management intent regarding their sales. The securities are reported at fair value on the balance sheet. And then next is equity securities. Equity securities represent the ownership interest in another entity. Example are common and preferred stock and right to acquire or dispose of ownership interests such as warrant, stock right, and call and put option. There are some types of securities regarding to amount of ownership. First is non-influence or less than 20% of holding. From the theory, when someone hold a number of shares less than 20%, they do not have significant influence on the company, making the investor dominant become follower in the company's activities. Second is significant influence between 20 and 50 holding. When someone holds a number of shares more than 20 until 50%, in theory, they have a significant influence to the company, making the investor dominant become controllers of the company's activities. In the recording of this investor using equity method due to the existence of the significant influence as if the test arise to the company. And then controlling interest holding more than 50%. Holding more than 50% are referred to as controlling interest, where the investor is known as the holding company and the investee as the subsidiary. Consolidated financial statements are prepared for holding more than 50%. And then analyzing investment securities. Analysis of investment securities has at least two main objectives. First, to separate operating performance from investing and financing performance. Second, to analyze accounting distortion due to accounting rules and or earning management involving investment securities. what is separate operating performance from investing? That is, operating and investing performance of the company must be separately analyzed. This is because a company investing performance can distort its true operating performance. For this purpose, it is important for an analysis to remove all gains or loss relating to investment activities, including dividends, interest income, and unrealized gains and losses. When evaluating operating performance, an analysis also needs to separate operating and non-operating asset when determining to the return on net operating asset, or RNOA. Second is analyzing accounting distortion from the securities. ASC 320 takes an important step toward fair value accounting for investment securities. However, the standard does not fully embrace fair value accounting. Instead, the standard is a compromise between historical cost and fair value, leaving many unresolved issues along with the opportunities for earning management. This means an analysis must examine disclosure relating to investment securities to identify potential distortion due to both accounting methods and earning management. This analysis is especially important when analyzing financial institutions and insurance companies because investing activities constitute the core of their operation and provide the bulk of their income. Some of the potential distortion caused by the accounting for investment securities that can analyze must watch for: first, opportunities for gain trading; second, liabilities recognized at the cost; third, inconsistent definition of equity securities; and the fourth, classification based on intent.
Right, now we are going to talk about equity method accounting. When should we use equity method rather than other method? Equity method accounting is required for intercorporate investment in which the investor company can exert significant influence over the investee. Once the investor company can exert control over the investee company, consolidation is required. The equity method is sometimes referred to as a one-line consolidation. The primary differences between consolidation and equity method accounting rise in the level of detail reported in the financial statement, because the consolidation process does not affect either total stockholders' equity or net income of the investor company. So now, assume that Global Corporation acquires for cash a 25% interest in Synergy Incorporation, which is for 500,000, and it is representing 1/4 of Synergy stockholders' equity as of the acquisition date. The investment is therefore acquired at book value. Synergy's condensed balance sheet as of the date of the acquisition, as we show you on the right side. So you can see here that the stockholders' equity is 2 million, and our investment is only 25%, right? So that the initial investment recorded on Global's book journal, it could be investment debited 500,000 and then cash credited 500,000. Global reports the investment account as a non-current asset on its balance sheet. This 500,000 investment represents 25% interest in an investee company with total asset of 6,300,000 and liabilities 4,300,000. Okay, now subsequent to the date of the acquisition, Synergy reports net income of 100,000 and paying dividend of 20,000. So Global Corporation records its proportionate shares of Synergy's earning and the receipt of dividend as investment debited as of 25,000 and equity in earnings of investee company credited 25,000. And then we can also record the receipt of the dividend. it is 25% of the dividend. Cash debited 5,000 and then investment credited 5,000. Global's earnings have increased by its proportionate share of the net income of Synergy. This income will be reported in the other income section of the income statement as it is treated similarly to interest income. Okay, now we are going to talk about the analysis implication of intercorporate investment. Equity method accounting assumes that a dollar earned by an investee company is equivalent to a dollar earned for the investor, even if not received in cash. While disregarding the parent's potential tax liability from a remittance of earnings by an affiliate, the dollar-for-dollar equivalence of earnings cannot be taken for granted. The reasons are: a regulatory authority can sometimes intervene in a subsidiary's dividend policy, and a subsidiary can operate in a country where restriction exists on remittance of earnings. Dividend restriction and loan agreements can limit earnings accessibility, and also presence of a stable of powerful minority interest can reduce a parent's discretion in setting dividend or other policies. The investment account is often referred to as a one-line consolidation, as I mentioned in previous slide, right? This is because it represents the investor percentage ownership in the investee company's stockholders' equity. Behind this investment balance are the underlying assets and liabilities of the investee company. There can be a significant amount of unrecorded assets and liabilities of the investee company that are not reflected on the balance sheet of the investor. And then, when the undistributed earnings of a subsidiary are included in the pre-tax accounting income of a parent company, it can require a concurrent provision for tax. This provision depends on the action and intent of the parent company. Current practice assumes that all undistributed earnings transfer to the parent, and thus a provision of tax is made by the parent in the current period. This assumption is overcome. However, if persuasive evidence exists that subsidiary either has or will invest and distribute earnings permanently or will remit earnings through a tax-free liquidation. Alright, now we are going to talk about business combination. Business combination with sound economic motivation have a long history. Among the economic reasons for business combination are: first, acquiring valuable source of materials, productive facilities, technology, marketing channels, or market share. Second, securing financial resources or access to them. Third, strengthening management. Fourth, enhancing operating efficiency. Fifth, encouraging diversification. Sixth, rapidity in market entry. And 7, achieving economy of scale. And 8, acquiring tax advantage. We shall also recognize certain intangible reasons for business combination. In certain cases, these intangible are the base explanation for the high costs incurred. They include management prestige, compensation, and prerequisites. Management's accounting choice in recording business combination are often better understood when considering this motivation. Consolidated financial statement report the result of operation and financial condition of a parent corporation and its subsidiaries in one set of statements. From a legal point of view, a parent company owns the stock of its subsidiary. A parent does not own the subsidiary's asset, nor it is usually responsible for the subsidiary's debt, although it frequently guarantees them. Consolidated financial statements disregard the separate legal identities of the parent and its subsidiary in favor of its economic substance. That is, consolidated financial statements reflect a business entity controlled by a single company, which we call as the parent company. Consolidation involves two steps that are aggregation and elimination. First, consolidated financial statement aggregate the asset, liabilities, revenue, and expense of subsidiaries with their corresponding item in the financial statement of the parent company. The second step is to eliminate intercompany transactions to avoid double counting or prematurely recognizing income. For example, both the parent's account payable to its subsidiary and its subsidiary's account receivable from the parent are eliminated when preparing a consolidated balance sheet. Likewise, sales and cost of goods sold are eliminated for intercompany inventory sales. In some business combination, the parties cannot agree on a price. This yields the notion of contingent consideration, where it is agreed that additional money will be paid by the buyer to the seller if future performance goals are met by combined company. Under current accounting, that future earn-out payment is recognized as additional purchase cost when money is paid. Okay, here we have several information related to limitation of consolidated financial statement. Some of the limitations regarding financial statement of the individual companies composing the larger entity are not always prepared on a comparable basis. Differences in accounting principle, such as amortization rates and other factors, can inhibit homogeneity and impair the validity of ratio, trend, and other analysis. And then, consolidated financial statements do not reveal restriction on use of cash for individual companies, nor do they reveal intercompany cash flow or restriction placed on the flow. These factors obscure the relation between liquidity of assets and the liabilities they aim to meet. And the third, you can see that here we put up during our analysis, and for its extent of intercompany transaction is unknown. Companies in poor financial condition sometimes combine the financially strong companies, thus obscuring our analysis because assets of our member of the consolidated entity cannot necessarily be seized to pay liabilities of another. Extent of intercompany transaction is unknown unless the procedure underlying the consolidation process are reported. And then the last is accounting for the consolidation of finance and insurance subsidiaries can pose several problems for analysis. Aggregation of dissimilar subsidiaries can distort ratio and other relation. For example, current assets of finance subsidiaries are not generally available to satisfy current liabilities of the parent. Assets and liabilities of the separate entities are not interchangeable, and consolidated financial statements obscure the purities of creditors' claim.
Derivative securities. Hedges are contracts that seek to insulate companies from market risk. A hedge is similar in concept to an insurance policy, where the company enters into a contract that ensures a certain payoff regardless of market forces. Financial instruments such as futures, options, and swaps are commonly used in hedges. These financial instruments are called derivative financial instruments. A derivative is a financial instrument whose value is derived from the value of another asset, class of asset, or economic variable such as stock, bond, commodity, price, interest rate, or currency exchange rate. Defining a derivative. The first one is future contract. It is an agreement between two or more parties to purchase or sell a certain commodity or financial asset at future date and at definite price. Second is swap contract. It is an agreement between two or more parties to exchange future cash flow. It is common for hedging risk, especially interest rate and foreign currency risk. And also the third is option contract. Grants a party the right, not the obligation, to execute a transaction. This accounting for derivatives. You can see that the exhibit 5.6 show the classification of derivative for accounting purpose. All derivatives, regardless of their nature or purpose, are recorded at market value on the balance sheet. And Exhibit 4.7 summarizes the accounting for different derivatives. The accounting for derivatives is different depending on their classification by the company. Derivatives are first classified as fair value, cash flow, or foreign currency hedges. And also, there is disclosure for derivatives. The purpose of this disclosure is to inform analysts about potential risks underlying derivative securities. The first one is qualitative disclosure. Disclosure generally outline the types of hedging activities conducted by the company and the accounting method employed. Second is quantitative disclosure. Example is Campbell Soup also provide quantitative information related to interest rate and foreign exchange hedging activities in the MD&A section of the annual report. The third is interest rate risk exposure. The higher this covariance, the greater percentage of debt the company can borrow on a floating rate basis and not incur significant risk to reported profit should interest rate fluctuate in the future. And also foreign exchange exposure. These loss or gain on asset and liabilities are offset via gains or loss in the foreign currency hedge, thus lessening the variability of its income. There is also analysis of derivatives. The first one is objective of using derivatives. Identifying a company objective for use of derivatives is important because associated with derivatives is much higher for speculation than for hedging. Second is risk exposure and effectiveness of hedging strategies. The analyst must evaluate the underlying risk for a company, the company's risk management strategy, its hedging activities, and the effectiveness of its hedging operation. The third is transaction-specific versus company-wide risk exposure. Companies hedge a specific exposure to the transaction, commitment, asset, and/or liabilities. And last is inclusion in operating or non-operating income. Another analysis issue is whether to view unrealized gains or loss on derivative instrument as a part of operating or non-operating income. Next is about fair value option. Let's talk about fair value reporting requirements. There are three. The first one is assets and liabilities eligible for the fair value option. US GAAP allows companies to report a wide range of financial assets and liabilities on fair value basis. These include investment in debt and equity securities, financial instruments, derivatives, and various types of financial obligation. And also, second is selective application. Companies are allowed substantial flexibility to selectively apply the fair value option to individual assets or liabilities. The flexibility is allowed when even within a specific asset class. Third is reporting requirement. If a company chooses the fair value option for an asset or liability, then the following reporting rules apply: that the carrying amount of the asset in the balance sheet will always be at its fair value on the measurement date. Also, all changes in the fair value of the asset, include unrealized gain and loss, will be included in net income. And the manner in which the unrealized gain or loss will be included is not specified. This fair value disclosure. You can see in the picture that Exhibit 5.9 is provide detail from the fair value footnote of Wells Fargo Bank September 2007 and 10 strip Q. Finally, the result is Wells Fargo reveals that it recorded a net gain of the $445 million in net income for all financial assets, for which it exercised the fair value option, and a gain of $477 million on mortgage held for sale. Analysis implication. The first one is reliability of fair value measurement. An important analysis task is evaluating the reliability of the fair value measurement and their effect on the financial statement. In this case, we cannot rule out the possibility that the assumption changes are attempt on the part of Wells Fargo to soften the unfavorable effects of the mortgage crisis on net income. Second is opportunistic adoption of SFAS 159. SFAS 159 allows considerable discretion to companies in choosing the specific asset or liabilities for which they exercise the fair value option. An analyst needs to verify whether the fair value election has been opportunistic with an aim to window dressing the financial statement. Wells Fargo has chosen to exercise the fair value option for prime residential mortgage held for sale and certain interests related to the residential loan sales and securitization. I think that's all for our video. Thank you for watching.